Bismillahirrahmanirrahim. Assalamu alaikum and welcome to another lecture. This is Musaddiq Keswani, your tutor, and today we are going to study a very important and a very interesting topic, that is the Boston Consulting Group Matrix, and we call it BCG matrix. Before studying the BCG matrix, as usual, we are going to first understand that how this model and in what scenarios these model helps us. All right, basically what is the purpose of this model, what is the objective of this model. So this model is basically used when a single company is operating or selling more than one product. All right. So you have to manage each product, that which product is performing well, which performing product is not performing well, which product we should discontinue, which product we should do more effort. So these kind of decisions BCG matrix help us to take. And not only this, but for example, if you are a parent company, if you are a parent company and you have like one, two, three, and four companies below you. One company is dealing in, let's say, healthcare product. Other company is dealing in the technology. The other one is dealing in the oil sector, and the other is dealing in the car or the automotive industry. So you have four kind of products under your parent company. All right. So now how the parent company is going to evaluate each product line, that which one is performing good, what should we do with this product? If this is not performing good, what should we do? Should we disinvest it or should we do more efforts, or what could be the strategies? So the Boston Consulting Group matrix or the BCG group matrix, it helps you in this thing. It helps you to manage your portfolio. It helps you to manage the multiple product line. And believe me, this topic is tested in exam on like 70 or 60%. Like if I talk about last 5 attempts, it is being tested for like 3 to 4 times. That it is how much important this topic is. So now let's start and see that what the BCG matrix is all about. So to use the BCG matrix, what you need to understand, you need to understand that on x-axis you have the market share. All right. So as a company, you are going to check that for the specific product, for example, for healthcare products, what is your market share? Like, is it high or is it low? For example, let's say I would say that the your market share as compared to the industry, total industry, is like around 10 to 15%. So 10 to 15% is, normally, or in the normal scenarios or the normal condition, it is a high share because you are having a substantial share in the market. But for example, if I would say that there are only three players into the market, one player has 80% share, you have 10% share, and also the other company has also 10% share. Now tell me, do you have the high market share or you have the low market share? Market share means how much the customers you have. All right. So in this scenario, again, the percentage is 10, but now based on the comparability, when you are comparing it with the others, now it is low. So you will have to check in the exam that what is your market share, and on comparative basis, is it high or is it low? And sometimes if the market is, well diversified, that many competitors are there, and everyone is having 1%, let's say 2%, 0.5%, 0.3%. So these kind of shares everyone have, and you have 5% share. Although 5 is very small number, but now as compared to all of them, 5 is the high number. So that is how you are going to identify this. And also the other thing is that sometime examiner will tell you that you are the leader of the market, or you are among the top 3 of the market. So this thing shows you that your market share is high, all right. And whatever your assessment is, whatever you have um, assumed, or whatever you have evaluated, whether high or low, just explain it to the examiner that why you are telling something high or why you are telling something low, because numbers are not themselves high or low, they are the relative things. So if you are comparing 5 with 1, it is high. If you are comparing 5 with 20, it is low. So that is you need to check. So the first thing is that you are going to see your market share. And then the other thing, you are going to see the market growth. That means that at which rate the market is going to grow. Market means that, for example, your market is now 1000 customers. And in coming year, you are expecting that the customer will increase to 2000 total customers, overall market. Your customers, your competitor customer, all combined basis, it is going to be 2000 customers. That means that the market is going to grow from 1000 to 2000. It means that it is going to grow by 100%. What do you think? Is it a high rate of growth in the market, or is it a low rate of growth of market? I'm not talking about your growth. I am talking about the growth of the market, growth of the new customers or the customers. All right. So you have to see whether it is low or high, and based on that, you will make four categories of your product, and you will classify them accordingly. For example, if your product is having, if in market which you are operating, or your product, for example, the healthcare product. So in healthcare market, your company has the high share, has the high share, and also the market growth is high. That means that you are expecting, or you can see that the market will grow in the future. So now we will say that your product is a star product. Your product is a star product because your product, you have the high market share in this product, in this market. You have a high share. For example, 10%, 15%, 20%. This is your market share. That means that in overall market, you have 20% customers. And the market is also going to grow in the future. So the market growth rate is high. We will call it the star product. Now the BCG metrics tell you something about the star product. Number one, a star product has a high relative market share in a high growing market. Okay, we understand this thing. This type of product may be in a later stages growth of its product cycle. That means that, when the market growth rate is high, it means that your product is in a growth life stage of its phase. Right? You remember that we studied the product life cycle. We studied the product life cycle. So we have the phases. We have the startup phase, then we have the growing phase, then we have the maturity phase, then we have a decline phase. So the star product usually is in its growth phase of the product life cycle because the growth rate is high. So that means that it is in growth rate. And sometimes examiner confuses you. It doesn't give you the percentage of the growth. It tell you indirectly that your product is in a growth phase. So if it is in a growth phase, that means that the growth rates are going to be higher. And that is how you have to be very attentive in the exam. Other thing is that the star may be only cash neutral despite of its strong position, as large amount of cash may be needed to spend to defend and build the organization position against the competitors. So the BCG matrix actually tells you that for a star product, since you have a high market share and the market is going to grow as well, so you should spend as much as possible. into what? Into your marketing, into research and development, so that you can become better and better and better, because the market is going to grow and you should also grow with the market. And how you can grow? You can grow by doing the innovation, by doing the research and development, by doing the good marketing. And they all requires the fund, they all requires the investment. So for a star product you should do the high investment, so that you can, one thing, defend your market share, and also increase your market share along with the market which is growing. Your market is going up, so you should go up as well. How? By innovation, R&D, marketing. All right. Then competitors will be attracted to the market by the high growth rate. That means, do you remember about the new entrants? New entrants. Yes, sir, we remember about it. So new entrants are likely to come into this market because new entrant will see that this is a good market, this is a profitable market, market is going to grow. Because initially no one would be there, because it's a new market, it is in growth phase, so everyone will not come into it because it's a risky thing. But now you are in the market, you are successful, you have a high growth, high market share, and market is going to grow. So the people will see that yes, it's a profitable market, okay, now let's jump into the market, and they will also come. All right. So what you need to do, you have to defend yourself from them, you have to defend your market share from them, because they are the new entrants and they will try to eat your market share. They often need heavy investment to sustain their growth. Failure to support the star sufficiently strongly may lead to the product losing its leading market share position, slipping into the right metrics and becoming the problem child. It is saying that if you are not going to invest on the star product, then there are chances that your star product will become a failure, because the market will grow, your competitors will innovate, your competitors will do research and development, they will get better, but you will not, and they will snatch your share, they will eat your share from you, and ultimately you will lose your position in the market. So this was the star product. Now let's move forward to the next quadrant of the BCG matrix. So the next quadrant we have is when you have the your market share in the product which we are talking about, because we have multiple products, right? So in the product, if you have a market share that is high, your market share is high, but the market growth is low, that means that the market is not going to grow, the market is already into the mature phase, the market is in maturity, and now the market will not grow significantly, it will grow slightly, very little, and ultimately it will go down. So the BCG matrix calls this kind of product cash cows. That means that now this product is your cash cow. Like cow, what it gives you? It gives you the milk. All right, it gives you the milk. But if I say that it's a cash cow, so it is going to give you the cash. It means that this product should be seen as the cash cow, that it is going to give you the cash. How it is going to give you the cash? Because you have a good market share, you have a huge customer base, and obviously the market is not going to grow. If the market is not going to grow, you don't need to do the research and development, you don't need to do the innovation, you don't need to do the very heavy marketing. Obviously you are going to do the innovation, R&D and marketing, but very little, as aligned with the market growth. If market is growing slowly, do R&D, marketing, innovation, slow, as with market. Because if you are doing the significant investment in marketing, in innovation, R&D, you will not get the benefit, because you will try your best, but market is not growing. So your strategy would fail. Your marketing cost, R&D cost, innovation will be wasted. So that is why BCG matrix says that do not invest or do not incur too much cost on the this product. This is your cash cow. Try to harvest, try to take the cash from them. All right. Now let's read it. In cash cow, Cash cow has a high relative market share is high, but low market growth and should be generating substantial cash inflows. It will give you cash inflows because you will not invest too much on this product. All right. The period of high growth rate has ended. Life cycle is maturity. As I said you that it is that product is in the maturity phase because the market growth rate is very low now, and consequently the market is less attractive to the new entrants and existing competitors. So you will see that the no not many new competitors will come because they know that there is no more charm on the attractiveness into the market, and also the competitors will take exit because the market is going down now. All right. Cash cow product needs to be managed for continued profits and tend to generate cash in excess what is needed to sustain their market position. It means that you are going to give the outflows as well. It doesn't mean that you are not going to incur any cost. You will incur the cost, and the purpose of incurring the cost would be to defend your market share because you have a high market share. So you should defend your share, and you should avail the inflows from the cash cow product, and your inflows should be greater than your outflows so that it will give you the profits. All right. It will give you the profits. Profits from cow support the growth of the other company's product. Therefore, the firm's strategy is oriented towards the maintaining the product strong position in the market. Why we are maintaining our strong position in the cash cow product? Because the cash cow product is going to give you the inflows of the cash or the profits, and you can use these inflows for the development of the star product or any other product of the BCG matrix. So cash cow is going to help you in this thing as well. All right. Now let's move towards the other quadrants and talk about the other category of the product. So the next thing we have is basically when your market share is low, you have a low market share as compared to the others. All right. But the mark and also your market rate growth rate is low. That means that market is not going to grow, and also you do not have the substantial or the high share into the market. That means that it is something that is useless for you. It is useless for you because neither the market is going to grow and nor you have a good position into it. So we call it the dog. We call it the dog product. Why we call it dog product? Because market is useless and you do not have a good position. So it's a dog product. And what is BCG metrics teaching us about the dog product? It is teaching that the dog product has a low relative market share in a low growth market. Such a product might have a negative cash flows or just break even that is likely to continue. Because again, you have a low market share. So if you have a low market share, it is very likely that maybe your this product is loss making. Your this product is loss making, and if it is not loss making, it would be on break even. That means your cost and profits are equal. All right. So now other thing is it is unlikely that the dog can fight for market share from the competitors. Again, since you do not have the good market position, one thing comes into our mind is that, sir, what about if we fight from other for the market share? No, dear, you cannot do this because already the market is in the maturity phase. Market doesn't have the potential. Market doesn't have the charm. Market growth is low. So you cannot snatch, and obviously you are in a weak position. So it would be very difficult for you to snatch the market share from the others. All right. So in dog, it is very unlikely that you do much effort to try to snatch the market share from the others because obviously there are big companies, businesses, successful businesses than you, and they would be occupying their position. They would be trying their best not to lose their share, and market is also not growing, so you would not be able to snatch the share from them. All right. Competitors who have the advantage of having the large market share are likely to fiercely resist any attempts to reduce their share of a low growth or static market. Again, obviously, if you would try to snatch their shares from them, The competitors are not weak like you, they are strong, so they are going to do something and they will not lose their shares. They will do R&D, marketing, or the innovation into your product, so that you will not be able to snatch from them their customers. An organization with such a product can attempt to appeal to a specialized market, immediate withdraw or harvest profit by cutting back support services to a minimum. The good strategy to deal with such product is that whatever the product, if your product is classified into dog category, the best way is that if it is a loss making, exit from the market, discontinue the product because it's a loss making and you do not see any future into this product. But if it is a break even, try to run the product so far that it is absorbing your fixed overhead, because fixed overhead they are going to incur, right? So your product is somehow absorbing the fixed overhead, so run it only if it is on break even. All right, or try to cut the cost or cut the service support system or the staff from this product, so that you can reduce the cost and move towards the break even, or if you are at break even, move towards the profit. Otherwise you cannot do much about it, right? It would be unwise to invest in any further capital in dogs in hoping of increasing the profit. So it is very, very likely that you will withdraw from the dog, and whatever the proceeds you will get from selling the dog product or the dog company, you can use it for the star products. All right, because you are getting the inflows and the star product needs it. So you can transfer the inflows to the star product or the sale proceeds to the star product. All right. Next, we have the last category. The last category says that if you have a market share which is low, your market share is low, but the market growth rate is high, we call it the question mark. It means that when everyone is earning, when everyone is growing, market is growing, your competitors are growing, why you are not growing? Why you have a low market share? And that is the question mark. And that is BCG matrix is saying you that you need to assess as a company that what is the problem. Why? Because if the market is growing, everyone is earning profits, why you are not able to earn the profit? Why you are not able to increase your market share to the high level? And BCG matrix says you to identify the problem, solve the problem, and increase your market share to the high level and earn the profits. All right. Now let's read it out. A problem child. We sometimes call it a problem child as well. So the question mark is also problem child. All right. These are the two names which are used by the different books or different examiners. All right, is characterized by a low market share and a high market growth. Substantial net cash input is required to maintain or increase the market share. It is saying that you have to invest. You have to invest into this product. Invest to identify, first identify the problem, resolve the problem, do research and development of your product, do innovation, integrate new technology, advanced technology, and also do the good marketing. So these all will take cost. You have to put cost into the question mark product so that you can make it successful. Because if you will make it successful, it will become a star. Because remember, in a star, the market growth was high and also market share was high. So if you will make the market share high, it will become star. All right, so you have a chance to convert your question mark into the star product. The company must decide whether to do nothing and let the cash continue to be absorbed or more market more intensively to get out of this market. Is saying that there are two options. That sometimes the company says that we are just leaving the question mark as it is. All right, just leave it. We are not going to solve it because it is in profits right now. As soon as it will become loss making, we will withdraw from this market like a dog. And sometimes the company says that no, we will put efforts, we will put funds, and we will try to solve this issue, we will try to make this product star. So these are the two strategies for the question mark product. Question mark can be the any other product. These are the categories, remember. If for example, I have audited one company, it was selling the ice creams, it was selling the shampoos, it was selling the soap, it was selling the healthcare or the beauty care products. So these were the four items which the company was selling. So which item is star, which item is cash cow, which item is dog, which item is question mark, you have to identify on the based on their market share and the market growth rate. All right. The questions are whether this the product can become successful with the supports and what the supports will be. So the main thing is that you need to identify that whether this product can become successful, and if yes, if you think that it can become successful, then find out what you need to do to make this product successful. All right. Now the last thing is basically what we have just covered. I will just go through it quickly and you will understand that we have covered it already. So the BCG metrics tell you four techniques: build share, hold, harvest, divest. So the build share means company can invest to increase the market share. Just look at this diagram below. So let me just zoom in for you what it does. It says that when you have a market growth and market share, all right. If let's say the market share is high, market growth is also high. It is a star product. It is a star product. So for star, what you need to do, you have to build the share. You have to build the share. Build your share along with the market so that the star can become the bigger star and give you the profits. All right. Then, if I talk about if you have a market share high and the market growth is low, market share is high and the growth is low, it is your cash cow. What you can do? You need to harvest. You need to harvest. Company reduces the investment in order to maximize the short-term cash flows and profit from the SBU strategic business unit, maybe turning stars into the cash cow. So you can use the, for example, when your star, obviously, sometime at some stage or at some point in time, stars would become low. Your stars will come down. Your market growth will your market of star product will go to the maturity. So your star product will go to the cash cow level. Your star will go to the cash cow level. So again, what you will do, you will try not to invest into the product because it is no more star. Now it has been shifted to the cash cow category. So if it is in cash cow category, harvest the profit, harvest the cash flows from it. Do not invest significantly into it. All right. And similarly, if you have the market share, it is low, and the market growth is high, it is a problem child. What you will do? You will do one thing: build your share, build your share into the problem child so that the problem child can become the star product in the future. And if it would become star, invest into it, build the share. And obviously, first it was problem child, you develop this product, you improve the product and it become the star product. And obviously at some point of time everything comes down, it will reach this point, it will reach this point. All right. So it will become the cash cow. All right. And this is how the cycle moves on. And then again you have the, if you have the low market share and your market growth is also low, it is your dog product. So what you can do? Diverse. Simply diverse. Company can diverse the SBU by phasing it out or selling it. Example, investing in the more promising question mark. So the, if you will sell it, if you will sell the segment or the business, you will get the sale proceeds. You can use sale proceeds here. You can also use the sale proceeds in the star. And the cash cow proceeds, you can also use it for question mark. You can use it for the star product as well. And hold is company invest just enough to keep the SBU in the present position. All right. So you can do this for cash cow as well, hold strategy. You can do it for the problem child as well, that you do not do anything and you just say, okay, let it be the way it is, and we will just bring out the cash flows. And for the dog as well, if they are not loss making. If it is loss making, if it is loss making, divest it. If they are not loss making, hold them. If it is star, or for example, build share. Let me just clear it and make things easy for you. All right. Yes, it is now all clear. So let me show you that what are the strategies which you need to do for them. If they are loss making, divest them. If they are not loss making, hold them. For cash cow, harvest them. For cash cow, harvest the profit from them. For, like, if they are not loss making, what you can do other thing is that for the problem child, you can build it, you can invest onto it, and you can improve it. And for star, build it. All right. So this is how the Boston Consulting Group Matrix teaches you how you are going to manage your portfolio. I hope that I was able to explain each and everything in detail. See you all in the next lecture. Till then, take care of yourself. Allah Hafiz.